Excellent. Thank you, Amy. And thanks for everyone joining us today. So this is the second in a three-part series covering the Inflation Reduction Act, the IRA. The first was kind of an overview. Today's session, we're going to focus on tax exempts. And then for those of you that maybe are more interested in the individual side or are interested in the individual side, our third webinar on December 14th is going to focus on what are some of the individual taxpayer considerations coming from the IRA. But specific today in tax exempts, I'm joined by my fellow partners, Mark, who leads our business credits and incentives team, Jim, who is a fellow partner in the National Tax Office, focusing on the R&D and the ERC. Myself, I lead our pass-through entity consulting group, a very long name, but really partnerships and S-corps. Mel is our director in charge of our DC office, focusing on what's happening all times up in Capitol Hill. And then Kim, who leads our tax-exempt group. So with that, quick agenda. We're going to just introduce our our tax-exempt practice to the audience and where we see some of the opportunities. Then we're going to hand it over to Mark, who can focus specifically on the climate economy and some of the different energy incentives and how that may work, allocating those incentives. Also, Mark's going to cover some of the affordable housing opportunities, rural electric cooperative opportunities, again, focusing on tax exempts. We're going to then have Mel step in and cover how the credits work, Energy Incentives 101, and also talk a bit about the investment tax credit. And then at the end, batting cleanup, we have Jim coming in to highlight what we're seeing in the tax exempt space for employee retention credit. So with that, I maybe turn this over to Kim to introduce herself and our tax exempt practice.
Great, thanks so much, Adam, and thank you all for joining us today. This is a new and exciting topic that we get to talk about in the exempt organization world. So as Adam mentioned, I'm Kim Henriksen. I oversee our exempt organization tax practice at iBailey, which really covers three of our largest industry groups, so our healthcare, our nonprofit, and our governmental or higher education industry groups. And fortunately, all of those entities are going to be part of this new opportunity that we're going to talk to you about today. From a iBailey standpoint, working with these groups, we do really full service tax services, from compliance to consulting. Most of the consulting that we do relates more to the day-to-day exempt organization issues, and pull in specialists from our other national tax offices to help us when new opportunities arise similar to this.
Thank you, Kim. And maybe, like you said, specific to today, but what's changed in the tax exempt space with the IRA? Why suddenly now when I read tax notes or look in the tax journals, why is everyone talking about tax exempts specifically?
Sure. So typically when we see tax law that comes about, we're really primarily focused on how it impacts the exempt organizations, and things like the IRA that had a lot of energy incentives. Quite honestly, even when I first read it, I kind of glazed over it a little bit because it talks about credits. And a lot of times credits aren't real significant for exempt organizations because credits typically only come into play if you're paying tax. So as we know, most of our exempt organizations don't pay tax unless we have unrelated business income. But what's unique about some of the credits that came into play with the IRA is that they are refundable credits. In other words, you can receive them even if you don't pay tax. And then there's also the opportunity to transfer the benefits or allocate the benefits to others, which allows the exempt organization to not get tax credit, but maybe get some reduction of cost on construction projects. So both of those things, because of the way the law was written, does provide a lot of opportunity that usually isn't there for our exempt organizations.
Yeah, got it. So don't pay tax, but you can still benefit potentially from these provisions.
Yep, absolutely.
Great. Thank you, Kim. And with that, we will turn it over to our illustrious BC&I leader, Mark Rogers.
Thanks, Adam. That was good. So happy to be here. And thank you for spending your Thanksgiving hangover with us today. Let's get into it. And welcome to game night. Like in all games, we'll start with a discussion of the rules, and you'll hear from me and Mel and Jim talking about that. And that's the first step for all games. You know, euchre, chess, Monopoly. So you learn the rules first. And since we're all new here with exempt orgs and these incentives, that's a good place to start. And then the strategy comes in. We're going to have discovery calls after in the month of December and January for people on this webinar to start to talk strategy and customize. It's complicated, but it's not complex and we can figure it out. And here are some examples of who is invited to play. So if you see yourself on this list, you're in the right place. If you are a for-profit interloper, that is okay. You can stay. The concepts apply to you. The monetization just might be a little different. And we certainly have had a lot of calls with, I'd say, in order, healthcare, institutions of higher education, senior living has been big, and then down the line there. And we're starting to pick up these conversations within these industries. Okay, so let's go big picture. There's been unprecedented government funding for sustainability and climate matters, ushering in what some are calling a climate economy. So what you're seeing at the nucleus of this bubble graph are three pieces of legislation. You see the infrastructure bill, you see the semiconductor chips bill, and the Inflation Reduction Act. And the Inflation Reduction Act is the one we're going to key in on. Still unsure about the inflation part of the Inflation Reduction Act, but there sure is a lot of energy incentives that they put into this. So we'll be focusing on the bubbles, the renewable energy bubble and the energy efficient bubble. So this is a takeaway slide. Again, a lot here. But as we go through the journey of figuring out what incentives you can apply for, we can customize what pieces of the law make sense. Okay, and if bubbles don't do it for you, how about cold hard cash? So at the passage of the Inflation Reduction Act, the Congressional Budget Office estimated about $374 billion would be given as incentives, and that was just their best guess over the next 10 years or so. However, many of these incentives are uncapped, meaning we can take as many as we want. So that is exactly why Credit Suisse wrote an article and came out with a new estimate, 800 billion. So they're a little bit more optimistic. They think people are going to actually use this more than the CBO thought. So really where the final number lands will be up to us and how much we utilize these incentives. I will say this, the government very rarely forces you to take an incentive. So you must be proactive in this space and see if we can't push this towards the 800 billion. So what you're looking at here, sustainable development goals, color-coded. This comes from the World Green Building Council. Came up with 17 of these sustainable development goals. And you'll notice that 9 of them, you're reading left to right, deal with green buildings, the space where a lot of these energy incentives come into play. So again, another takeaway slide to look at later, but this is something that these SDGs were adopted by all United Nations member states in 2015. And it's just showing how the recent energy legislation is mirroring kind of these goals that have been put out there. And in that same vein, we have the STARS program. Currently, there's no requirement for any tax exempt to report its carbon footprint yet. People are doing it anyways. 342 colleges and universities are competing through STARS to show how low they can go. So required or not, others are doing it. improving your lower carbon score may be a key element in protecting your reputation. It's kind of where the market is going. So to you do good, get these incentives, you might as well get the kind of the monetization while you're at it. And again, just continuing with this theme outside of the incentive space with ESGs, you may have heard of this. It's essentially a measurement tool, but these conversations with ESG are coming into the boardroom. They're coming up with leadership. They're coming up with your shareholders, your users, your customers, your employees. And certainly a lot of what we're going to talk about today is in the environmental. A lot of the energy incentives and the building certifications can be found in that E. Jim will be talking a little bit about the employee retention credit, and that kind of falls into the social and employees. But really the governance, how leadership governs and communicates these initiatives to their stakeholders is important. That will come into play. So it's all coming together, the legislation, the ESG, the sustainability, and it's coming together for exempt orgs at a really good time. Okay, this is the 5-4 slide. So one of the incentives, and there are many, when we talk about the energy incentive program, there is 700 pages of stuff. The two that really stand out is this building energy deduction, and then the energy investment credit, which is section 48, and Mel will be talking a little bit about that. So aside from exempt orgs being allowed to play in this space, the IRA enhanced the building energy deduction in two big ways. First, it went up to $5 per square foot. And for those who haven't played this before, it was at $1.80, so a very material number. And with this energy deduction, the more square footage, the better. Typically with energy efficient construction for your buildings in the lighting space, the HVAC space, and building envelope. And then the 4, it can be claimed every 4 years. So in the past, you can claim this deduction on a building, and that was it, lifetime. Now, every 4 years, as long as you're updating, putting in LED lights, changing out the HVACs, you can take the whole square footage of that building, potentially, every 4 years, just like the Olympics. All right, so how do exempt orgs monetize this particular incentive, this energy deduction? Let's look into that. Okay, so really there's 3 players in this. And we're calling this the energy deduction allocation program. So you need a third party, professional engineers and CPAs to certify. You need the designer to play ball, and the designer is defined as the architect, the engineer, could be the general contractor, could be the subcontractor, it could be a combination. It doesn't have to be just one, though many times it is. And then you need you, the exempt org. The government has been able to play in this particular deduction allocation for a while, albeit at the $1.80 level, but now healthcare and K-12 and senior living and all the ones I showed on the previous slide can get in on it. And so this is how it works. It's a square footage. So the square footage, and in this example, I think it's, let's see, I gotta minimize, 625,000 square feet, and that's a lot. We've had conversations as low as 50,000 square feet where this makes sense. We've gone as high as 2.5 million square feet. But 625 multiplied by the $5 gets the deduction. That's the carrot to build efficiently. $3.125 million deduction at a tax rate for the designer. The designer gets the deduction. They have $1 million plus of tax savings. So how does that break down for you? Well, there's a certification fee that the third party collects from the designer. And the designer, typically in the form of architect fees reduced or some type of discount or rebate, there's an allocation fee that's given, in this case $250,000, to the tax exempt. And that allocation fee is for an allocation letter, and we'll get to that next. But really quick, the benefit summary of this, it's a win-win-win. The designer gets their deduction, tax affected, minus the fees they pay out. The tax exempt gets their allocations fee, and then the fee given for the certification. So what is this allocation letter? This is something that you, as the exempt org, have to sign, put your John Hancock on, in order for the designer to get the deduction. Under penalties of perjury, the form is quite simple, but there is risk involved, there is value involved, and it's at your sole discretion to find the designer that actually would want to play ball. Some architects might be ESOPs or not needing the deduction, so finding that partner to play with here. We are advising our clients to be thoughtful and strategic with allocation letters. Don't just give it away. There needs to be some thought put into it. All right, here's the come together slide. So there are a lot of players in this space, and this is true for the deduction allocation and very true for when Mel speaks about the energy investment credit. Everyone kind of has to come together. Not one division owns this. So from a leadership point of view, from the governance, there needs to be some sustainable planning. What are your goals? What are you trying to achieve with your construction, with your campus, with your layout? What kind of image are you trying to project to your shareholders? And that needs to tie in with the accounting and finance teams. What's in the regulations? What is the IRS looking at? And how do we plan for that? And then, of course, your facility engineers and the construction managers and the GCs need to be in the conversation. So we're reaching those goals in the master planning, or even in the repair and maintenance annually of the building. All three of these divisions need to be talking together and coming up with a plan. Configure a plan for a capital expenditure process that satisfies your organization's energy goals. And this is what the IRA and these new laws are opening up these doors for exempt orgs. Okay. Oh, and now time for my one of my favorite conversations I've had in the last 3 months. So put into perspective, I've spent the first 20 years of my career consulting on incentives in the for-profit world. It's been wonderful. So when the door opened in August of this year for exempt orgs, I began having completely new conversations. And I didn't know really what to expect. One controller I talked to for a hospital system out west, undergoing a massive campus master plan, renovations, additions over a few year period. So I had a conversation, did some education, went through the bells and whistles of the new law, and then kind of just waited, sat back and said, man, what are you thinking? Does this work for you? Does this work in this industry? And she emphatically said, it's about time we get something. And right then I knew, I was like, the next 20 years of my career, I might be spending in the NFP EO world. Certainly I'm hearing a lot of pent-up demand. I'm hearing a lot of WIIFM, what's in it for me? And the dozens of conversations I've had in the past few months. It's bubbling up. Okay. Now, really quick, I'm going to talk about rural electric co-ops and affordable housing, because these are two that maybe dabble in not just the exempt orgs, but the for-profit space. But know that as we talk and as Mel talks, this applies to you. So on the rural electric co-ops, typically it's for those who are generating the electricity. It seems to work better, these incentives that we're going to go through, not just distribute. And so for those rural electric co-ops that are using solar, wind, geothermal, whole list that Mel's going to get into, you'll be incentivized in this space. I don't know of any other co-ops that get this kind of treatment, but really the rural electric co-ops is one where we have to think about. Let's go to the affordable housing.
Mark, I'll just break in for just a second, but
Yeah.
one of the common questions we get, and I'm sure our tax exempt clients and friends out here in the audience have, is, so you have all these variety of benefits, credits, deductions, and so forth. Are they generally mutually exclusive? You know, meaning that you can only claim one, or could you claim multiple with a single project? Could you claim multiple benefits?
That is a good question, and fortunately, stacking is allowed for a lot of these incentives. The government, you saw the World Council, you see other governments, you see ESG and sustainability, all these goals are all coming together right now. They want everyone to play ball. They want everyone to participate. So, and the spirit of the law is to reward energy efficient behavior and sustainable behavior. So in that vein, they want you to take as many of these as possible. Shoot for that 800 billion. In this case, for affordable housing, the biggest thing they did for affordable housing was they're allowing you to stack the 45L credit, which is a $5,000 per unit or per dwelling, up to $5,000 starting in 2023. They're allowing you to take that credit and the low-income housing tax credit that we all know and love, or those in the space know and love, at the same time. Before the law, it would reduce basis if you took the 45L credit. So most people say, you know what, I don't want to mess with my LIHTC credit, stay away. I don't want the energy credit, the 45L. Now you can get both, and it's a beautiful thing. And layering on top of that, opportunity zones, state credits, cost segregation, everything that in the past has been brought up can kind of layer on to this. And so that's why, yeah.
Even state incentives, right? We're federal practitioners, so we tend to always focus on the feds, but would state incentives even possibly be in play?
Yeah, no doubt about it. So you're going to be hearing a lot about federal stuff, and that's where we're looking through the law. But states incentivize this type of behavior too. And some states, California, Texas, really good with some of these energy incentives that need to be paired up nicely. Now, how they get paired up, you know, that's when you talk to your accountant, you talk to the National Tax Office and try to figure these things out. But yeah, they're making it as easy as possible to layer all these things on. And just one more slide on 45L. Again, exempt orgs are involved with the sponsor in this affordable housing and sometimes take over the project after investors leave. So there's some crossover here. And a really big boost to the 45L is that it was always 3 stories or less if you're constructing or renovating, which is great for buildings that were 3 stories or less. And I couldn't tell you why that definition was in there. And now I really don't care because they got rid of it. They made it easier. So any building of any size, apartments, senior living, multi-family housing, home developers, the sky is the limit.
Very good, and thank you, Mark. And let's, as I said, let's move on now to the question. Mark has given us, I think, an excellent run through of an area where tax exempts are very much eligible to share in the benefits that the government is using as incentive to move forward with greater energy efficiency, having tripled the total amount that tax exempts can share in. We're going to move from that to the changes that were other changes that were made in the recently enacted legislation that directly affect the ability of tax exempts to actually let the government help fund their environmental initiatives. Some of these are going to stack with the activities that Mark talked about. Some other of these are going to be ones that we approach directly. But in any case, let's move forward with that. And what changed? What is the big piece of legislation that was included in this? There is a new section of the Internal Revenue Code, section 6417. And what 6417 says that if you are one of a chosen group, which is essentially tax-exempt entities are the chosen group, then with respect to the credits that were either added or were expanded or extended in the environmental area in the recent legislation, with respect to payments that are made, credits that are generated beginning in 2023, you can have the cash. Who does this cover? As we said, tax-exempt entities, state and local governments, the Tennessee Valley Authority, Indian tribal governments, rural electric co-ops, really anybody who is typically not paying tax because they're not subject to federal income tax on their normal activities. UBIT is always a separate issue for tax exempts. We'll talk about how this can affect UBITs in a little bit, but right now we're going to focus on more of the pure tax exempt situation. The new idea is this concept of direct payment, or as Mark referred to it, as Kim referred to it, as a refundable credit. And what this is going to do, it says if you, a qualified entity, we had that on the last list, essentially, you're not subject to tax on your normal income as a matter of law. Then if you elect, and this is going to require a specific election to be filed, although that election doesn't have to be filed until the tax return is filed, then you can treat that applicable credit as a payment of tax. And if you don't otherwise owe any tax, then that payment of tax becomes a refund. If you do have UBIT, then this is something, it will offset the UBIT. Any excess becomes, as we said, a refund. Now, there is some question as to how the timing of all this is going to play out. The way the statute is written and the way it is, I think, likely to work in terms of tax-exempt entities is 60 days after either the due date of the return, or if you don't file it on the due, or you extend the date that you file the return, the IRS has 60 days to send you the money. The IRS doesn't send you the money within the 60 days. The IRS owes you interest on the money that it didn't send you. But in any case, what we're talking about is a direct payment of the money from the IRS to you. All right. What are we talking about applying here? Well, I think for most tax-exempt taxpayers, what we're going to tax-exempt entities, excuse me, I should say most of what we're going to be looking at are some of the traditional items that have been eligible under Section 48. You put up a solar panel, you get a credit. You put up a wind turbine, you put up a credit. Geothermal, fuel cells, micro turbines. Some of the areas that people don't always think about are the combined heat and power systems. So in other words, you're using a system to heat a facility and then you draw power by using that excess steam. Putting that kind of equipment into place or improving that kind of equipment is the sort of thing that creates an eligibility for a Section 48 credit. Used to be, we didn't have to think about it. Now, particularly if it's something we're going to put in place after the beginning of the year, it is something that we want to be able to think. Are we recovering waste energy? Yeah, this is, are we storing energy? Batteries are a big part of how the movement forward with regard to alternative energy How do you store the energy from solar? How do you store the energy from wind? How do you store energy that comes from something that is not a 24-hour source, like burning fuel oil, which is what we're trying to get away from? And interesting new items that were effectively added are microgrid controllers, things that allow you to better manage the use of electricity within your system. And that now is also eligible, as is what they call biogas. And biogas is, everything else here has been production of electricity, typically, or heat from an alternative source. Absolutely new area is if you have agricultural waste, if you have biological waste, and you can concentrate that and extract the methane. So you are using methane that is coming from the biological source rather than simply allowing it to gas out into the air. You also are eligible for the credit. I know we've talked to a couple of agriculture schools with dairy operations, with feedlot operations, where this is going to be may already be an area they are looking into, but certainly an area that is now potentially going to be a source of methane gas to be used for energy purposes on campus, coming directly from the, excuse me, manure that is being produced in the dairy. Now, what do we get for all this? Well, there's a series of credits, and this is the idea that this is a series of credits is somewhat new to the operation. Basic credit is 6% of cost, which doesn't look that good, particularly when you consider that the traditional credit under Section 48 was always 30%. Well, you can still get access to the 30% of cost. It does require that you meet certain wage rules. Essentially, you're going to, when the construction takes place, prevailing wages in the area for the service that is being provided by the laborer has to be met. But there are ways to take that 30% higher. If you meet some domestic content requirements, we can add another 10%. If by luck you are located in an energy community, and this is a defined thing, it's not something we can really plan for, but it's certainly something we can look for to see if there's an availability to you. Let's add an extra 10% onto there. And in fact, if you have somehow obtained an environmental justice allocation under the IRA, then you may be able to stack that on top of what here could be ultimately a 50% cost sharing through this credit with the government. Now, we mentioned wage rules. All right. In order to qualify for the 30% credit, you've got to pay prevailing wage. Who do you have to prevailing wage to? The statute says laborers and mechanics. It doesn't say engineers. It doesn't say executives, laborers and mechanics. And this must take place during the construction, alteration, or repair of the facility. Does anyone know exactly how this is going to apply? Well, the answer is no, because the IRS has not yet told us. So, in the wisdom, occasionally we do get some wisdom out of the legislature. The new rule does not apply unless construction begins more than 60 days after the IRS tells us how to determine what prevailing wages are. And okay, as the IRS has not published that guidance. The IRS is going to try and get the guidance out by the end of the year, but that is going to be a race for them. We've talked with people in the national office of the IRS. They're making their best effort to get it out. But this is, it looks like at least going to give us a period of time in January, perhaps in early February, where we're not going to have to deal with this, where we're going to have a period to figure out how we can build these new prevailing wages prevailing wage requirement into our construction plans so that we can qualify for this full 30% sharing, the 40%, maybe the 50% sharing of costs with the federal government. Now, we were talking about Section 48, and I really invite you, if you have questions regarding that, please submit something in the Q&A. If we don't get to it today, I'll make sure that we get back to you personally with respect to that. Yeah, Adam.
Mel, there is a question, and we may not be able to answer it. It's a pretty specific question, but I'll just read it to you. This is in the Q&A. Does the 48 credit, ITC credit apply if, and this looks like it's an electrical co-op question. If we purchase a portion of our electricity from our normal utility, which has allocated a portion of the energy from a wind farm they've built. So I guess, could they indirectly get the credit if they're purchasing it from a utility and then the utility is generating the energy from a wind farm?
I think the expectation on that one is no. That when we talk about, when the statute talks about the rural electric co-ops being eligible, they really are focused on energy that is being produced by the electric co-op itself. Now, until we get regulations, until we get some guidance, and we have virtually no guidance so far with regard to how all of these rules are going to apply, we can't say definitively that it's not there. But I think the general understanding is that this is intended to be focused on the generation side. And so that if what you're doing is you are primarily acting as a distributor, then and not as a generator, then most of the 48 credit is probably not focused on you. However, there are parts of 48 that deal with questions of storage. They deal with questions of efficient apportionment, efficient allocation of electricity. And it may well be that as we look deeper into the details of those provisions, there will be something that will be of benefit and a potential credit for the rural electric co-op that is really acting as a distributor and not as a generator.
Got it.
Well,
And I see,
yeah.
well, sorry, one other thing. I just see a bunch of questions have come up. We're going to try to cover these. Suddenly, Mel, there's about 6 questions came in. And not surprising, Mel's bringing good information, but I think we'll try to cover these at the end because otherwise we won't finish. So,
okay.
Sorry
and
to
while
interrupt.
we're talking here, the CPE poll has just popped up again. So we want to make sure that everyone that needs CPE gets their CPE. So please go ahead and do click on that. And while you answer that, I'm going to go ahead and talk through. Now, it's not just Section 48 that is eligible for direct pay. There is a whole laundry list, as I said, and these are really everything that was either added or was extended or expanded as a result of the Inflation Reduction Act. Alternative fuel vehicle, the correspondent to Section 48. Section 48 is an investment credit for putting in service things that produce power from an alternative source or create a greater efficiency in the utilization of that power. Section 45 is the production credit side and is really applicable in situations where you're generating the electricity and then selling it. For most tax exempts, that is not the area that we have seen focus, but is certainly one. There are some new areas that are going to be very, very interesting. I don't know of any tax exempt that is involved immediately in zero emission nuclear power production, but there is a credit there. There are a series of others that are related to clean electricity production, clean fuel production. These are ones that are going to be coming into existence a little farther down the line, but are going to be there and are going to be available for the direct pay. The vehicle issue, there, we're going to get to that. I've got a slide for that at the end, and if you'll bear with me, let's hold off on that until we get deeper there. And I must need to click here again. And now I'm back in. Okay. A question that frequently comes up. All right. As a tax exempt, we are supported frequently, not just by our own activities, but by funding from the outside. Well, what effect does that outside funding have? And the investment credit is essentially based, Section 48 credit we've been talking about, is essentially based on what you invest. So if you have general funds that are being invested in the new solar facility to heat the new dorm, or the new windmill that's going to provide power for the new hospital wing, then all of that cost should be eligible for Section 48. If, on the other hand, you have funding that is specifically allocated to your solar panels or your windmill, the expectation is that is not going to be available for Section 48. And I think this keys into questions of planning. So even if we go to a contributor and say, as we build this building, as we improve this function, we want it to be energy efficient, we still want that to be part of a general grant and not anything that is specifically apportioned. And this may involve making our contributor understand what this means to us as a tax exempt. Yes, we know that you want to support solar. We know that you're there to support solar. Don't tell us we have to use this money for solar, because if you do, you have just wiped out what would otherwise be a 30% cost sharing that we could get from the feds. Another issue that comes up is the use of tax-exempt bonds, particularly, remember, government entities, by and large, are included in the qualified group that we're treating as tax-exempts here. Generally, there is a percentage reduction as to the amount of credit that you're going to be eligible if you use a tax-exempt bond fund. Now, typically that's not 100%. The percentage varies depending upon which credit we're looking at. Generally in Section 48, it's a 50% reduction when we're using tax-exempt bond funds. Again, to the extent the tax-exempt fund, the bond can, that we can get, if we can get funding out of general funds and not out of a allocated tax-exempt bond, then we're going to be looking at being able to claim the full amount and not being able to take reduction. There are also a few grants that come directly from the federal government that are going to involve a 100% disallowance. And that's simply something, it cannot be avoided. It's simply one of the, it's the cost of taking the money. I guess what they're saying is, well, you know, if we're going to give you all the money, then we're not going to give you an extra 30% on top of it. And we might like to have that 30%, but let's not say that we automatically get it. Does it have to work? If we're talking about experimental, yeah, it needs to be something that's placed in service. So yeah, it probably does have to work. There is an area, Section 48C. This is one that we're not really ready to play in yet because we're going to need some significant rules. These are advanced. This is developing new ways to make the kind of things that we need for clean energy. And I think this is something that, because we're not really ready to go with it now, hopefully we will be able to cover as a as an issue in a seminar somewhat later as we begin to see that kind of rule keeping. What are our filing and record keeping requirements? The IRS will tell us. I mean, this is all new. The expectation is keep track of what you're doing. Be aware that we're ultimately going to want to use it, and we'll find a way to make things fit.
Hey,
Yeah.
Mel,
Oh,
I
yes.
had a question for you, but it's actually, there's a good question from the audience, I think, that plays into this. So the question from the audience is, and I'm looking at my other screen here, but how will tax incentives work with public-private partnership projects? You know, will there be separate conditions? And I think this even plays into a larger question of, there have been other structures before where public-private, you know, tax-exempt entities working with taxable investors, and there's existing structures in place for how that would work. And now we have this new structure where potentially you don't, maybe you work with a private investor, maybe you don't, you can monetize potentially the credit, but how do you sort through all of this now with these new statutory provisions?
You have to run the numbers, essentially. I mean, we have, as you say, there are situations where we have private ownership of the property in a public-private operation, and there the credit is simply facilitating the ownership on the side of the private ownership side. We have situations where we may use a, you know, sort of a traditional tax shelter partnership investment, which we clearly can do because we use set up a blocker and again move the tax benefits. Now the question I think really you have to ask is, what's our benefit in that approach? Not only the ultimate tax number, the ultimate cash number, but also what is our source of funds? Do we need to have that private partnership in order to generate the kind of capital that we want to have? But if we have our own capital, you know, maybe that 30% we're talking about is a more beneficial number than we could have received through the typical existing private partnership situation. You got to run the numbers. But in order to run the numbers, I think we have to understand this new benefit that is available to us. Let me just briefly mention tax exempts. Well, as a consumer, there is a whole series. The key here, I think, is going to be there are new commercial vehicle rules. So to the extent you can, there are going to be some significant credits which we can use as direct pay for the use of trucks, buses that are energy efficient. And I really appreciate everyone. As I say, we're going to get to, I will personally answer any of the questions that either are in or you want to send in. But I do want to turn over to Jim Donovan, because there is one last area that we want to make sure we get some coverage on today. So everybody click on your CPE poll so you get credit. And Jim, let me turn things over to you.
Awesome. Thank you, Mel. I appreciate it. All right. I know that many of you probably have a hard stop at the top of the hour, so I will try and be efficient with your time, but we will go a little bit over. That said, we'll try and make sure we get that last CPE poll in here. So let's talk ERC, and if I can get there we go. So the employee retention credit, right? That's what I'm going to talk about today. I'm guessing most of you have heard of the ERC, have an inbox full of emails from ERC providers offering giant credits, no less, or have already taken advantage of the incentive. But for those that haven't, the ERC is an employment tax incentive designed to reward you for keeping employees on the payroll during the pandemic, right? So initially, the credit kind of flew under the radar. There were these things called PPP loans that got all the headlines, and rightfully so, right? Basically free money. But the ERC has proven to be a formidable benefit, and we'll talk about that today and how it could benefit your organization. All right, so let's hit some of the basics here, right? So basically, the ERC came out in 2020. Again, it's COVID legislation. It was originally just for 2020, but expanded twice. So in 2020, basically, we have a credit up to $5,000 per employee if you're an eligible employer. In 2021, that credit jumps up to $7,000 of potential credit per employee per quarter for Q1, Q2, Q3. So if you're doing math at home, that's up to $21,000 per employee in 2021. Again, assuming you're an eligible employer. And we'll get into eligibility here in a minute. You're probably asking, gosh, Jim, why is Q4 not in the bill, or why is it not available? I get that question a lot. The Congress actually repealed Q4. They used it as a pay for in the infrastructure bill. So Q4 is off the books unless you're a recovery startup. Basically, if you're a business that started after February 15th, 2020, you could be qualified as a recovery startup business and qualify for ERC in Q3 and Q4 of 2021. If you are a business that hasn't heard of ERC and you're like, gosh, you know what, I may be a startup, you certainly want to reach out to us. There are a lot of specific rules around that, but just wanted to let you know it is an available benefit for you. All right.
Hey, Jim,
Yeah.
maybe before we start on the next slide, but what are some of the wins or successful projects we've had recently or to date with tax exempts in the ERC? Can maybe some examples?
Excellent question, Adam. And like Mark, I spent the first, ridiculous number of years of my career dealing with for-profit businesses, right? So it's been a ton of fun for the last 2+ years to work with exempt orgs. And really where we've seen a lot of benefit for the ERC, healthcare has been a big one. We have government orders that limited or suspended elective procedures, right? So you can qualify that way. Senior living is a big one that we see in the healthcare industry. We have a lot of government orders, and we also have some that qualify on gross receipts. Education is a second area that we're seeing a lot of exempt orders qualify under. K through 12. There's a lot of government orders that said, hey, kids couldn't be in school; they had to go virtually. And then community colleges, again, limiting class sizes under the government order or gross receipts. So that higher education has been a good area for us. Other nonprofits include chamber orchestras, museums, and churches, are just a few of those that we're seeing. Ooh. Somebody's pushing us to the end. They don't like my
Sorry, Jim. That was my fault. Apologies.
No worries. All right. So great question, Adam. So just kind of as the decision tree here, we do look at the nonprofit governmental entities. You can certainly qualify for ERC. There are rules around employer size, qualification criteria we'll get into in a minute, and then we do your calculation. All right, so let's talk about how you're an eligible employer, right? So the bright line test is a significant decline in gross receipts. So in 2020, if you have a decline of greater than 50% of gross receipts in a given quarter versus that same quarter in 2019, you're a qualifier. In 2021, that rule is actually, it's a heck of a lot easier to meet. You just need a decline of greater than 20% in the same quarter. Again, always comparing back to 2019. So for example, if we qualified, we'd look at Q1 2021 versus Q1 2019. Do you have that greater than 20% decline in gross receipts? If so, you qualify. There's an alternate quarter provision or a look back provision that allows us to qualify maybe 2 quarters if you qualify for 1. I will also say that the gross receipts definition, which we have to look at, it's not net income. It is very inclusive. Basically, all forms of income are assessed in determining eligibility under the gross receipts test. The other thing to note is aggregation rules do apply. So if you're part of a controlled group, we often have to look at, we do have to look at, total gross receipts for the entire controlled group. Same for employee count. All right, you may be telling me, gosh, Jim, you know what? Donations were up. I didn't have a decline in gross receipts. Is there another way I can qualify? Absolutely. The other way to qualify is due to a basically a government order that fully or partially suspends your business. Now, you only qualify during the suspension, but going back to my earlier example, right? If you're a chamber orchestra and there were state orders in effect that didn't allow you to perform because we couldn't have more than 50 people in a location, you would qualify while that government order is in effect. Basically, you know, there is a more than nominal test. We do have to have basically a government order, and then there has to be some sort of an impact to the entity based on that government order. So there's a few tests we need to effectively assess to say, yes, we're an eligible employer. Essential businesses, it doesn't automatically disqualify you from being eligible from the ERC. So again, hospitals, they certainly weren't shut down, but elective procedures were certainly would be a qualified government order that impacted your business. You know, if you are an exempt org, but you could go home and basically do all the same functions, teleworking, you know, you're likely not going to qualify. Also, if customers were required to stay at home, right? That demand principle is not enough to say you're a qualified business. Supply chain, I do get a lot of questions on this. You know, again, we have to have a government order in place. There has to be a more than nominal impact to qualify you for ERC. So again, happy to have those conversations. All right, how do I claim the credit, right? So this is an employment incentive. Oh, and that last poll just popped up right at the top of the hour. So again, if you want CPE, please take advantage of that. Basically, you claim the ERC on your 941X, so it's amended payroll tax return. Again, those are filed quarterly, so you can go back and amend for these credits. In this case, you're all paid up, right? So you should get a refund of the cash, the ERC. Mistakes do add significant time. The IRS is taking forever to process these. We're seeing anywhere from 6 to 15 months for clients to get refunds back. Again, it's an incentive that people are taking advantage of. The one good thing is there's not an imminent due date here. We have until April 15th of 2024 to file our 2020 ERC claims, and then April 15th of 2025 to file our 2021 ERC claims. All right, so the good news is if you haven't taken advantage of it, you haven't missed out yet. Plenty of time to qualify and take ERC. All right, did want to talk about IRS processing. I mentioned, gosh, it is taking forever for the IRS to pay these claims. It was originally scored as an $800 billion incentive. They already have 2.2 trillion in claims and lots of unprocessed 941Xs. So the IRS is just understaffed and undermanned, and they're really struggling to process these. We also have the Inflation Reduction Act with $80 billion of IRS funding. Well, what does that mean? Well, it means we have 300 IRS agents that are now trained for ERC audits. We also have the IRS and the AICPA reaching out with warnings about ERC mills. So I mentioned earlier that maybe you have an inbox full of these ERC providers, right? Promising giant credits. The IRS is certainly warning consumers, hey, be careful. A lot of these ERC mills, they're qualifying everybody, specifically under supply chain, and they may not actually meet the definition to be an eligible employer. So be very careful. We do recommend you meet with reputable providers to get your ERC done right. You know, what does this mean for the audit environment? We really don't know yet. We've had a couple of audits come through, but again, this is very, very early in the process. You know, are they going to attack based on the size of the claim, the industry? If they can figure out who the ERC mills are, will they go after those? There is a voluntary disclosure form to report ERC mills. So that's out there. Or will there be some other method of pursuing these audits? We just don't know yet. Again, we recommend you use a reputable provider to get your ERC done. If you think you may qualify for ERC, you can go to eidbailey.com/ERC. You can download a PDF, basically an assessment form to take a look, or you can submit online and we can get back to you and say, yep, you know, it looks good, or hey, we don't think you qualify, right? All right. So one of the things I wanted to highlight here, one of the cool takeaways about EIEIO, right, energy incentives and employment incentives for exempt orgs, is something Mark and Adam and Mel mentioned earlier, is really the ability to stack these benefits. EOs have often been left out of tax incentives, but Congress seems to be making up for it, right, by offering several incentives, and you can stack them. Take multiple incentives, not just say, oh gosh, this is one I want to take advantage of, or what's the value of this one versus that one, right? There's some of that out there in terms of production versus investment credits. You can take, 45L and ERC. So I love the pancake picture. It's lunchtime, so I might be hungry, but I know our clients love the stack of money, right? So you can stack these credits. That's an important takeaway here. All right, let's talk about next steps here. I know we're a little bit over time, but we do have CPAs, professional engineers, HERS raters. We have attorneys on staff who are actively following, ERC, all the IRA legislation and guidance. So, we're here to help you. Don't hesitate to schedule a call. Our contact information is in the slide deck. And we can help you guys with any of the incentives. Some we'll have to wait until we get final guidance on, but we're happy to help you when we can. So thank you all for your time. We really do appreciate it.